I'm Diego Sanchez, COO of HousingWire, and this is 10-Minute Talks. My guest today is Odeta Kushi, Deputy Chief Economist at First American. Odeta, welcome to 10-Minute Talks.
Thanks, Diego. It's great to be here. Thanks for having me.
It's so great to have you on. Before we dive in, could you give a 30-second introduction of yourself and your work at First American?
So I'm the Deputy Chief Economist for First American Financial Corporation, which is a leading provider of title settlement and risk solutions for real estate transactions. And in my role, I'm responsible for preparing analysis, commentary, and forecasts on trends in the real estate and mortgage markets.
And so are you looking, or is your team looking across the whole housing ecosystem in that analysis and research?
That's correct. I've really focused a lot of my research on demographic trends, millennials in particular, and how they impact the demand side of the housing equation. And then, of course, what's going on with all the supply factors in today's market.
And there is a lot going on. And I'd
That's
love to
right.
ask you about a couple of hot topics. So we have an ongoing battle between our editor in chief, Sarah Wheeler, and our lead analyst, Logan Mohtashami. Sarah's in the camp that there's a mortgage rate lockdown. Logan doesn't really believe in the mortgage rate lockdown. Where do you fall in this debate?
Well, I'm a big fan of both Sarah and Logan's, but what we're seeing in the data is, 10-year length in the United States has hit a historic high of over 10 years. In other words, existing homeowners, they're not moving, they're staying put. And that's a result of several factors, one of which we do believe is the rate lock-in effect and has been exacerbated by the recent increase in mortgage rates. But there's other factors. There's a longer run factors of seniors aging in place, for example. And then, of course, the rate lock-in effect is a function of the fact that a lot of homeowners, more than 90% of homeowners, are locked into rates below 6%. And rates today are hovering just above 7%. So there's a financial disincentive for homeowners to sell. And then, of course, there's something that we like to call the homeowner's prisoner's dilemma, which is an economic concept, a game theory concept. It's a situation in which individuals don't cooperate, even though it seems in their best interest to do so. So if all sellers today chose to sell their homes, they would benefit as buyers because they would increase the inventory of homes available for sale and alleviate the supply shortage. But the risk of selling when others aren't in a market with a shortage of inventory is keeping existing homeowners from selling altogether. So there's all these dynamics at play, but I do believe that the rate lock-in effect is exacerbating the housing supply shortage.
I like that way of thinking about it, the homeowner's prisoner's dilemma. Do you have any research upcoming or blog posts that describe that in a little bit more detail?
We do. We have several blog posts on our economics center. It's firstam.com/economics that talks all about the housing prisoner's dilemma, talks about, aging in place, talks about the rate lock-in effect, all of that.
Awesome. So regardless of what's causing it, we're all feeling the effects of a very difficult housing market. We've got really high mortgage rates and stubbornly high home prices as well. So when do you think we'll start to see some relief on either side of that, either with mortgage rates or with home prices?
Mortgage rates are notoriously difficult to forecast because they're loosely benchmarked to the 10-year Treasury yield, which is influenced by all sorts of factors, everything from, geopolitical conditions to, of course, inflation. And so it's very difficult to forecast. But I think that mortgage rates are unlikely to decline meaningfully in the near term unless inflation makes significant progress towards the Federal Reserve's 2% target or there is significant economic decline. But with that said, if inflation continues to trend in the right direction and the Fed signals that they're done hiking rates, we could get some reprieve from rising mortgage rates. On the topic of prices, that's an interesting one because obviously we've seen a meaningful decline in transactions, but prices continue to go up. We just hit another historic high in house prices. And that's because house prices are downside sticky and the limited inventory of homes for sale is really keeping a floor on how low prices can go in today's market, despite the rising interest rate environment.
So is that sort of a catch-22, right? Like we've got high mortgage rates, which is a mortgage rate lockdown, which is leading to low supply, which is leading to higher than what you would expect home prices. How do we kind of break through that catch 22?
Yeah, it's tough. I mean, one thing that's helped is the new home side, new home construction, because existing homeowners aren't moving, so existing home inventory, which traditionally has made up and continues to make up the bulk of overall inventory, is very limited. And so buyers are increasingly turning to the new home market because builders are offering incentives ranging from, rate buy downs, sometimes buying down rates to the 6%, 5% range, offering quality upgrades on homes, and sometimes cutting prices. And so, buyers are turning to the new home market, which has traditionally been more expensive than the existing home market. But now that builders are trying to offload inventory and offering these rate buy downs, it can in some ways be cheaper to buy a new home in today's market. And then, there are some mitigating factors to the rate lock-in effect. We do have 42% of owned homes are owned free and clear in today's market. So these are people who are not disincentivized from selling due to the rate lock-in effect. And then, of course, we've got high levels of home equity that could mitigate the impact of the rate lock-in effect. A lot of equity-rich homeowners, it means that maybe moving and taking on a higher interest rate isn't a huge deal, especially if you're moving from a more expensive place to a less expensive place.
It's been nice to see the new home construction add some to supply, but we're starting to see signs that mortgage rates might even head higher than where they currently are, which is really high, and maybe even go over 8%. Do you think there's a limit to what the home builders can do in terms of rate buy downs when rates go above 8%?
I do. I think margins will be challenging to continue to buy down rates the higher that mortgage rates go. And we saw in the latest new home sales report that new home sales actually declined. And context is important here. New home sales are still doing significantly better than existing home sales, and really are in line with the pre-pandemic levels. But even so, higher mortgage rates impact the demand side of the equation. We've seen higher mortgage rates prompt lower builder sentiment. And so it could start to impact the amount of home building that's done. And of course, the number of home sales, new home sales, that is.
So it seems like we're back to the Fed in terms of what can really move the needle. And their big focus, like you said before, is on inflation. Do you think they're winning this war against inflation that they've been fighting?
We've certainly seen significant progress, and there's reasons to be optimistic. One of those reasons comes back to our industry. Shelter inflation makes up a pretty sizable chunk of the overall CPI, a little bit less so in the PCE, but still fairly significant in the PCE as well. And we know that shelter inflation lags observed changes in rental and house prices. And so we should start to see the decline in rent that we're seeing in sort of more the real-time data. We should start to see that show up more meaningfully in that CPI, which will drag the overall CPI lower into next year. And so shelter is one reason why I think the CPI is likely to go lower into next year. And of course, the Fed signaled in their last meeting that we have maybe one more rate hike to go this year and then potentially 2 rate cuts next year. So I think they're also signaling that we're pretty close to the end of the tightening cycle, but headwinds remain. We've seen energy prices increase that could impact inflation expectations. It could impact other parts of the CPI, as we know. And so we're not out of the woods yet, unfortunately.
Would you be surprised if the Fed raised again before they lowered?
I wouldn't, simply because they've told us as much. The projections implied 125 basis point hike this year. Unclear if that will be at the December meeting. And then they also signaled that we'll stay higher for longer, which unfortunately does mean some more upward pressure on mortgage rates.
So, what is your team currently working on in terms of research and analysis? I imagine it's focused on these problems that we've been talking about in our current housing market, but would love to hear from you what the team's working on.
Working on a bunch of different things. It's busy times, but I think one thing that's really interesting is our team was really interested in trying to define what is a housing recession. We've been throwing that term around for a couple of years now, and of course, we have a pretty decent understanding about regular economic recessions, and so we decided to create a comprehensive rule-based model sort of based on the method of calling economic recessions. And it relies on 8 economic indicators. And what that model is telling us is that the housing market was in recession last year between May and November, but pulled out of recession earlier this year when mortgage rates eased and the new home market started to recover a bit. Unfortunately, that model is also telling us that the housing market has now fallen back into recession in the summer months as sales have come down, mortgage rates have increased. And so we're really focused on maintaining that model and really keeping a beat on what's happening in the housing market and what this model is telling us.
Not a great report today from NAR in terms of pending sales. Are you seeing that as an anomaly, or you think we're kind of firmly back in a housing market recession?
Unfortunately, I think, higher mortgage rates, we've seen mortgage rates creep even higher, alongside rising treasury yields. Unfortunately, that's a headwind to sales. And so the pending home sales came in way below consensus expectations today. It's a volatile series, so it's likely that maybe that gets revised in the next month. Nevertheless, we look at mortgage applications, we look at pending home sales as leading indicators, and it does look like we're facing headwinds in the for transaction volumes.
Odeta, thank you so much for joining me today. It's been great chatting with you.
Thanks so much, Diego. It's a pleasure to be here.